Hello friends, beautiful greetings of the day to all of you. I hope you all are doing pretty well in your respective lives. So here I, Kunal Nagpal, would like to take an opportunity to welcome you all to today's economic session. Dear friends, today we are basically going to have a detailed analytical discussion on a very important aspect concerning our economy. As we have been observing from quite a number of months, our Indian currency, that is INR, has been facing continuous depreciation against the US dollar. As a result of this particular fluctuation in our currency, the international trade has been getting affected at a very great extent. For instance, the continuous weakening of the rupee is gradually becoming a headache for the Indian exporters due to the continuous surge in the value of the US dollar. Keeping in mind, US dollar is actually world's dominant currency in which the international trade is being carried out worldwide. So let's have the detailed, insightful discussion in this particular aspect. So the current currency movement is creating a business environment fraught with uncertainties, says Nashik-based exporter Mr. Muthukumar Raju, the founder and director of Enrock Impex Private Limited, which exports textiles, carpets, plastics and kitchenware, says it takes nearly 30 to 50 days to actually execute an order. But the rupee dollar exchange rate changes between the time the business deal is signed and the goods are exported. So this exchange rate fluctuation also increases the cost of raw materials that are to be imported. Hence, in such cases, a surge in the dollar does not help the manufacturer or the merchant exporters, says Mr. Raju. The US dollar, the world's dominant currency, chiefly responsible for driving the global trade flows, hit a 20-year high against a basket of currencies last month. The strengthening of the dollar is actually expected to continue as the Federal Reserve takes steps to control inflation in the United States, and the currency becomes a prized commodity for the investors, leading to a rapid spike in its demand. Therefore, this has posed challenges for every economy worldwide that trades in dollars. It has affected the Indian trading community in multiple ways. The rupee has dropped nearly 10% this year against the dollar, says the industry estimates. Technically, the overall appreciation of the dollar and the resulting depreciation of the rupee is supposed to make exporters happy as they get to accrue more value per US dollar against their shipments. However, industry observers say the situation is actually not as simplistic as it looks this time around, keeping in mind the current global economic scenario is quite volatile and uncertain. Also, as we have been quoting, that the overall intensity of fluctuations caused in the Indian economic parameters is actually quite less with respect to the fluctuations caused in the same parameters in other parts of the world. We have been giving credits to the overall political system and the economic system of our of the framework of our country. Yes, this is the main advantage of the leadership of our country. However, this particular plus point is actually becoming a disadvantage for the exporters this time around. You may ask why? Here is the reason. Contrary to the general perception, Rupee depreciation is not helping our exports as our competitors' currencies are depreciating at a steeper pace, says Ajay Sahai, DG and CEO, Federation of Indian Export Organizations. The rupee is actually one of the best performing currencies in the world with very few exceptions. Therefore, relatively speaking, we are losing out to our competitors as far as the exchange rates are concerned. Now let's have an overview on a particular point, that why it is becoming expensive to make and sell. Industry observers say the exchange rate is only one factor in the competitiveness of exports, particularly as we still have a few supply side challenges. So the import intensity of exports has increased in many segments, nullifying the gains and in the traditional sectors of exports, which are primarily made of domestic inputs. Inflation has blunted the overall competitive edge, says Sahai, adding that the global slowdown will affect the demand and our exports. And the soaring dollar has compounded the woes of importers as it spikes the import bills. This is not at all the good news for importers of the raw materials. Mr. Raju knows this end of the business also, as he imports plastics and kitchenware from Hong Kong and China. Medium and large firms are actually opting for the currency hedging. Mr. Raju says his bank had suggested that he lock in the price in case he expects the remittance next month. So the expectation is that the dollar rates would go beyond the 85 to 86 mark till November or December and remain high till Christmas. On this note, I would like to bring to your notice that the current rate of INR per USD is actually 82.43, and within next 1 to 2 months it is being predicted that it would reach to nearly 85 to 86 INR per USD. This is really alarming. That will be the time when we may see the rupee's slide to actually get stabilized. It should stay stable till the next festive season, he says. But industry observers say that scenario depends on the Russia-Ukraine war not escalating. It is still a question mark, because the ongoing Russia-Ukraine war as of now in today's date is actually getting more and more intense. As a result, the global times are actually becoming more and more sensitive with each passing day. So for many countries, the weakening of their respective currencies relative to the US dollar has made the inflation fight even harder. The weakening rupee against the dollar has become a huge deterrent to the import business for the Indian economy, says Dhanraj Kidiyur, the founder and CEO of WIP, a digital platform for agri exporters. Most importers are pushed towards exploring the alternative methods or instruments to keep their trade going. The current market and world economies are also very hostile to the way the countries like China, the USA, the UK, Vietnam, Sri Lanka, North Korea, Russia and Ukraine are behaving. So with this, the import sentiment is being hurt not only because of the forex risks, but also because of the overall instability and the war-like situation facing some countries. He says, yes, today's global times are actually becoming more and more sensitive. Yes, this is a very crucial time for every economy across the globe. Mr. Kidiyur says India exports nearly 382.3 $1.3 billion worth of goods, whereas the imports are about $469.5 billion, which brings us to a deficit of nearly $87.2 billion. Now let's have an overview of certain sectors in the Indian economy which still stand to win. As of now, for the Indian economy, the overall manufacturers and the exporters segment face higher production costs as the imported inputs become expensive. So the impact is more in the sectors where the operational cycles depend on steady supplies of raw materials such as pharma and auto industries. Mr. Sekar Dalmia, President of industry body PHDCCI, says the import content in our production processes is actually high. He estimates it at around 20% of a product. So, the imports of raw materials at depreciating rupees reduces the price competitiveness of the producer in the international market. The exporters of the traditional sector's goods such as textiles and leather may have been benefited, but import-intensive products such as electronics, automobiles, organic chemicals and the basic pharmaceutical industry are facing a rise in the prices, he says. India's textile sector, the nation's second largest after agriculture in employment generation, looks well placed to gain from the dollar surge. The industry is broadly cotton based and there has been a steady decline in the cotton prices over the past few weeks. This wasn't the case only a few months ago when the raw cotton and cotton yarn prices were at an all-time high. Mr. Anand Srivastav, Director of Skewer Export and Import, says the textile sector is actually benefiting because of the dollar's appreciation. Some buyers are even giving us 40 to 50% of the order value as advance. Players in this segment see this as a golden opportunity. Mr. Srivastav says while the volatility in the immediate term may be good to make the quick financial gains, it certainly hurts the market sentiment in the long term. Enrock Impact's Mr. Raju agrees the dollar surge is actually encouraging the exporters to seal the orders that were earlier held up because of the price issues. Every exporter in his network is actually revising the prices to accommodate a certain discount component to seal the business deals. So, the trade volume is actually increasing. Previously, our business contracts were falling apart, mainly because of the disagreements over the quoted prices. This is not the case anymore, says Raju. As a merchant exporter of textiles, he is quite aware that many buyers are comparing their rates with China and Bangladesh. A couple of orders were held up by the buyers because we could not meet their target price. But now, with 5 to 15% discounts on offer, we are better placed, he adds further. Now let's discuss what are the basic pain points for the Indian economy. But not all segments have been this lucky. Stakeholders in the country's engineering sector, a leading forex earner, call the dollar surge a mixed bag. The engineering goods sector made up the largest share at 27% of the exports basket in April to December 2021. Engineering Exports Promotion Council, that is EEPC, India Chairman Arun Kumar Garodia says a stronger dollar is actually good for the Indian engineering exporters in the short run. However, it is likely to hamper engineering shipment in the medium term. Importers may actually ask for a discount if the rupee depreciation persists for months. Several items in the engineering sector have a substantial amount of imports. The dollar surge is definitely bound to affect those segments. Mr. Karodia gives the example of the segments such as steel and automobiles. Some items are not produced in India at all, and the manufacturers depend on imports to make the finished goods from these items. Therefore, the price of these products will go up in the domestic market, and exports of these products will be dearer as the import of inputs will be costlier. So the dollar appreciation is actually lower in emerging markets than in advanced economies, but the impact is quite larger in emerging markets that have higher import dependency. The players in India are just trying out several measures to safeguard themselves. Mr. Kidiyur says large export houses are well established and know how to play the forex game. So, most large exporters would have a ratio of the percentage of forward future booking vis-a-vis playing the risk with open markets to actually settle at actuals. Some have a ratio of say 80% forwards booked versus 20% on actuals. Some 60-40 or up to 50-50. Hedging also requires a considerable amount of security or collateral to be given to the banks. Therefore, this leads to a considerable amount of capital being blocked here, he says. So on this note, let's discuss the hedging situation. This situation does not help the medium and small exporters. Those who do not have hedging capabilities are having to make better pricing decisions based on the situation now. Srivastav of Skier says MSME exporters are actually avoiding hedging solutions at banks because of the paperwork and other requirements. Instead, buyers and sellers have adopted an old simplistic method. This is how it's implemented. With Russian and Panama buyers, we have fixed a dollar INR conversion rate, say at 82. Now, if the exchange rate goes higher, the buyers gain, else the exporters gain, says Mr. Srivastav. Some traders are actually betting on the Reserve Bank of India's decision to allow the Indian banks to work out special corresponding Vostro accounts with the foreign banks to trade in the rupee. The move will basically help us even deal with the countries that are under the US sanctions and those having the foreign exchange shortage, says Mr. Sahai. Though some banks have received RBI approval, but the operation has not started yet. The two Russian banks have opened the Vostro accounts to settle the payments in the rupee. Mr. Sahai says he hopes the system will become more common. Industry officials say the government intervention is actually required to provide the Indian economy and businesses with the required safeguards against a rapid depreciation of the rupee. Therefore, at this juncture, we should buy the raw materials from the countries that accept the rupee transactions, says PHDCCI's chief, adding that the measures such as reducing excise duties on key import products will also help. EEPC's Mr. Karodia says RBI's intervention in the currency market can actually provide some cushion. Measures from the central bank to boost the capital inflow into NRI accounts may also help to arrest the depreciation of the rupee. So, while nothing can be done to immediately arrest the fallout of a strengthening US dollar, the government and industry can minimize the ramifications and therefore find ways to benefit from the boom. So dear friends, on this note, I would like to basically end our today's discussion. I would like to basically state and I would like to basically state a particular statement that the overall scenario prevailing in the global economic environment is actually quite sensitive. Yes, we all know this. So, though our economy has an advantage that the intensity of the fluctuations caused in our economic parameters is actually quite less with respect to the fluctuations caused in other parts of the world. Yes, this is definitely an advantage for the Indian economy, which is basically indicating the overall stability and the excellent leadership style, the excellent protocol being followed by the overall framework, by the overall governing framework of our country. Yes, it's definitely a plus point. But as we have discussed, it is actually becoming a little disadvantage for the exporters, because as other countries are facing steep fluctuation in their respective currencies, as a result of this particular fact, they are getting more advantage in their export businesses in comparison to the Indian exporters. So, my dear friends, as we have discussed the detailed insights in this particular aspect, that in next 1 or 2 months, it is being projected that the value of INR per USD is expected to go to nearly 82 is expected to go to nearly 85 or 86 per US dollar. So and then it would gradually stabilize if the Ukraine-Russia war situation gets resolved to normalcy, which is still a question mark. So at this point, at this critical point of time, the solutions being given by the leading pioneers like Mr. Sahai, who has basically stated certain solutions of hedging, right? And the corresponding benefits of these solutions for short term, medium term and long term have been discussed in detail in our discussion. So I hope you all have been benefited immensely with this session, and I really want all of you to actually ponder deeply on this particular topic, so that you may also give your valuable insights in our comment section, and I would try my best to make those points visible to the respective authorities. I would try to highlight them. So this is the basic this is the request from me to all of you to actually give your valuable insights on what can be done with a very innovative approach, which would help the Indian economy in this current prevailing time of uncertainty. Thank you so much. Namaste.